send over to me questions or topics that you're struggling with. Otherwise, I'm going to pick a handful of things that I have. Well, what we're going to discuss every week are a handful of topics that I think either will be tested, like a high likelihood of being tested, or they're kind of like obscure topics. And for those of us that we know that, or for those of you that we work together, I'll sometimes say, let's increase your chances of passing the exam, maybe by just 1 or 2%. We'll take that all day long, right? Especially if there's not a huge time commitment for a particular topic. Today we'll go over insurance. Let's say next week, let's do retirement next week, and taxes afterwards. And just like I've mentioned in the other weeks, if no, I haven't put a syllabus together or anything like that. This is annual review time for my financial planning clients. So, I just have difficulty finding time or extra time. But I'm always happy to be here on Monday evenings with you guys. I enjoy the conversation. So, and hopefully you do too, and you're getting something out of it. What we're going to do today, talk about insurance. And yes, I think that the handful of slides that I put together for you guys will increase your chances of passing the board exam by 1 or 2%. Maybe you get, 1 or 2 or 3 more questions correct because of what we're going to go over tonight. Elise, where can you find the recording sessions from the last couple of weeks? You can't, because I set it up not to record, unlike tonight. So going forward, I didn't select that. It was my mistake. I'm going to pop these up on my YouTube channel. They won't be edited other than the first, few minutes, or and that's it. So I'll pop those up. Maybe I should be able to actually get to that tonight. Okay. So sorry about those first few weeks or first couple weeks. I thought I was recording them. All right, so let's look at insurance. If you guys have questions, either speak up or you can send me a message through the chat. Elise, you missed last week. Okay, last week we did calculator. I am going to make a video on basic to medium to advanced topics on the calculator. That will go up on my YouTube channel as well. I'm getting there. Okay, so just be a little bit patient with me, which I know you guys are. Okay, so, but yeah, at least the last week was calculator. And, I know most of you guys are, not all of you, most of you guys are like, obviously like within 2 months from the exam, not to give you a panic attack or anything like that. But calculator in general is one of those topics, even when you're 2 months out for the exam, that you're still not going to be crystal clear on. When you get to the exam, you probably won't be crystal clear on every calculator question. You're going to get on your exam either 3 to 5 calculator questions. It's going to range from about 3 to 5 up to 15 to 20 from what I understand, from what I hear. Let's put it that way. Okay, different versions of the exam. Going to have 2 people take an exam. One will get 3 questions out of 170, and somebody else will get 15 questions. All right, so now let's cut right to the chase. Let's talk about insurance. And if you don't come from an insurance background, there are some things that can be confusing about it. Let me straighten out this. Let me actually make this PowerPoint a little bit more manageable to see. Talk to your clients about insurance, please. I know, if that's not in your wheelhouse, and we'll get to the test stuff in a second. Okay, that's fine. Refer them. Please make sure they have insurance. Unfortunately, a client of mine over the weekend passed away, a very sweet lady. And, thankfully that I talked to her about insurance about 7 or 8 years ago, and that's going to help out in the family quite a bit. Do you have to be an expert in insurance stuff? No, you don't even have to sell it, but you've got to make sure clients are protected and at least have that discussion with them. A topic of discussion on insurance. Um, so here, topic and discussion on insurance regarding the exam. When you get insurance questions on, let's say, like a case study, a lot of the details are going to be in those footnotes. So I want you on the case study, which we'll cover a case study before we're all done here. I think, what are we, 3 weeks in? So we got another 7 weeks or so to go. And so we're going to look, you want to be looking at the details, and typically what the board is going to want you to identify is that we're going to have underinsured people, whether it's underinsured on the life side, long-term care side, not so much on the guaranteed income side, like annuities. Yes, that's, annuities are an insurance product, but the exam is going to test your knowledge of annuities. And yes, the application, but they're going to be very interested in if you understand the tax consequences of getting annuity payments, or taking an annuity out early, or taking, if you take a distribution, does it come out like a Roth? Is it first in, first out, or is it last in, first out? All right. So those are the things we want to pay attention to for insurance. Typically, again, we're looking for somebody who is uninsured or underinsured. And we're going to be looking for family situations too, right? We got the husband and wife, and she's a professional, he's a professional, but he's I don't know, just finish his internship. He's going to start making money as a doctor, but they're still kind of younger and starting out and stuff like that. But in 5 years, he's going to be making big money. But now they got a kid on the way, and how do they take care of that so that they can have insurance down the road? And oh, by the way, the husband or the wife have some sort of family history. Maybe it's usually like one out of two of them have some sort of family history where all the men in the family have a heart attack or at age 40, or all the women by age 40 have breast cancer or something. And so how are we going to protect the family there? Okay, so look out for scenarios on that. You got to have the knowledge, of course. How do we apply it and read through and cut through all the nonsense that the board is going to give you? Okay, so all right, now let's look at what the heck happened here? Here we go. So let's look at insurance, the different types that we got out. We have term and permanent, or we just call it term and perm. This is not going to be a basic insurance course, but I know a lot of you in practice don't deal with insurance, and I'm going to give you one couple pieces of advice on insurance today, or teach you a little bit about it, so that when you get the board exam, at least you can think your way out of questions if you just understand some basic things. So for maybe like a half of you, how many do we have tonight? Oh man, we dropped off. Last week was 38. I must have not done my job well. So you got 30, we got not 30. We got two types of insurance, generally speaking. So you got term over here, you've got permanent insurance over here. Okay, now some people say there's term and whole life. So that used to be the case before there were other types of permanent insurance. But so term, you're going to want to know about like increasing term. You'll want to know a little bit about decreasing term and for whom this applies. Like a friend of mine, when he started his dental practice, needed a $700,000 loan. You better believe that the part of the condition of extending that loan to my friend, who is my dentist as well, made sure, or not made sure, but they said, we're not giving you a loan unless you got a decreasing term policy with us. And it's going to be a 10-year loan. And every year, the face value is going to start out at 700,000. I think it was in that ballpark, and it'll drop every year by 70,000, the face value, because you're going to be paying off $70,000 a year in the loan. So we as the bank don't have as much on the hook, right? Or we're not on the hook for as much. Okay, so where does increasing term and where does decreasing term come in? What's the story with like level term? And so when I'm saying these things, you guys want to be taking notes, and they don't have to be completely detailed notes, but we want to have notes to the effect of like, well, Sev said that we should probably know about this stuff. Okay, so that's where you want to be taking notes on. Then you go back and then you deal with your own flashcards or note cards, or your virtual cards, whatever you're doing. Okay. On the permanent side, then you've got whole, you've got basically you got whole and universal policies, and then you can have like a variable under universal. But the whole life, fairly straightforward. There's not too much in the way of questions that they can ask you. Whole life is fairly simple. Penn Mutual, whatever. Just use Penn Mutual as an example. They'll just say, "Hey, look, here's the quote. It's 10 grand a year. Pay us, and we'll cover you until the day you die, until your age 100, or the day you die, whatever is sooner. And if you stop paying the premiums, that's it. Then you don't have coverage anymore, and we pay out the cash value to." Universal is a little different, and this is where the confusion and the problems, might come in on the board exam part of it. Yeah, and so where it comes in is that they're like, what's going on with the premiums? So the premiums that go into these policies, just think of it, they go in three different directions. And again, I'm mentioning this because I know you guys are 2 months away, but I think if we can lay a pretty solid framework or a foundation about some of these more confusing topics, I think it'll be good for all of you. But just keep in mind, like, what's going on with the universal policy is that the premiums that are being paid basically go in three directions. So you've got administrative expenses, or we can put like commission charges in here. Okay, it's kind of cut off there or whatever, but yeah, commission charges. And then we're going to pay for the actual insurance, the mortality expenses. Let's just call it the insurance charge, the actual product of the coverage of the life insurance. All right. So because here we got to keep lights on, administrative, we got to pay the sales guy for the commission or whatever that comes out to be. But then we've got to pay for the actual coverage here. And then anything that's left over goes into the cash value. In this cash value, we're going to earn, generally speaking, we're going to earn interest, and the company might decide to pay dividends. Okay, like Penn Mutual has been around for 10 million years. They've been paying dividends, I think, since they opened up in like 18 whenever. Okay, now where do we get into trouble with the universal policies? That if we stop paying the premium, the whole life policies, really, again, just generally speaking, we stop paying the premiums, then that's it. The policy lapses. They pay you out whatever accumulated cash value you got here. Universal policies can continue on until all those premiums are used up, and then that thing blows up on the client. For example, I'm running a financial plan for a client right now. The husband bought a universal policy back in the 1988. Okay, and premiums have been like $200 a year. He's much younger, obviously, almost 30 years ago. They were a lot less, $200. For whatever reason, stop paying the premiums, and they just came on as clients. So I didn't do this to them, and I certainly was not in business in 1988. Now the premiums, I believe, are going to be, starting this year, like $6,000, and next year it'll be $8,000, right? Because he's, now he's in his mid 60s. So watch out for that type of thing on the board exam, as far as like universal policies and where they come into play. They're gonna give you a scenario where it's like another newlywed couple, and husband and wife just started a business. They think they're going to do well, but there could be times where where business is going to slow down, just like any other business, and they need the flexibility. And flexibility is the key term with universal. So like I mentioned, whole life, yeah, you could get a question on it. Universal, I'd put my money on having more questions being asked about universal policies, because the flexibility, because of it's a lot more complex than a whole life policy. We can actually introduce like sub accounts so that we get market performance, not like performance we had today, although it was a pretty nice rebound today, I got to admit. Okay, so more complexity. If you're going to spend a couple hours studying up on permanent insurance, you're going to spend most of that time on universal policies. Okay. Annuities, the big thing that you want to know with annuities is the exclusion ratio for fixed and variable annuities. Now, let me look on the next slide for a second, because, and actually before I go to the next slide, or as I go to the next slide, let me know if any of you have a question or something insurance related that you want me to cover. Yeah, here we go. That's our exclusion ratio. So on the fixed, on the variable side, I think a lot of you see in your books, or I know a lot of you see in your books, when you're giving an annuity exclusion ratio question, it's a tax question. Now, why is this such a I mean, why do annuities, why are they favored by the board as far as a test topic? Because you're dealing with an insurance product, number one, an insurance topic, and number two, we can mix in a tax question or a tax component in there as well. All right, so I know a lot of you have probably seen this, where the guy sells his business and whatever, I don't know, he sells it for $200,000, and then he is going to get a payout for the rest of his life of, I don't know, $1,000 a month, 1,000 per month, per month for the next I don't know, next 10 years or something, over his life expectancy, whatever it is. And so what is that? 120,000, right? Something like, or not 120,000. Let's make this for 20 years. Sorry. Let's make that for 20 years. So 1,000 times 12, that's 12,000 times 20 years. That's 240,000 is his payout over his life expectancy. And so if we're talking about a fixed annuity, we just take 200,000 out of 240. So 200 divided by 240. And then what we have over here is an exclusion. We got an exclusion ratio of 83.33%. All right. 83. So 83% of each one of this guy's payments. So $830 out of each one of these payments is going to be excluded from taxation up until he hits his life expectancy. And if this guy is 65, 60-year-old male, males, I think we pass away, I don't know, maybe 78, 79, but let's say this guy's life expectancy is age 80. Now, every payment that comes in after age 80, watch out, it's going to be all taxable. All right. Why is that? Because he's recovered all of his basis here. Okay. So again, this is on the fixed variable side. Now, here's a little, the trick or something to be aware of on the exam. When you're dealing with ratios where we have to include something in taxation or exclude it from taxation, pick a lane and stick with it, right? You guys have already learned about the exclusion ratio. So when you get to other types of ratio related questions on the exam, always think that you are excluding something. That way that you don't make any mistakes jumping between exclusion and inclusion ratio, because I'll guarantee, well, I'll say it's possible, but I'll pretty much guarantee what they're going to give you a question on is they're going to say, calculate the exclusion ratio on this whole scenario that I gave you. And then somewhere down, a couple of hours down the line, they're going to ask you, tell us how much is included in taxation. And if you know how much is excluded from taxation, of course, you know how much is included. All right. So when you see ratio type stuff, you're just always going to be thinking, it doesn't always have to be tax related, but you guys are going to think about having to just calculate what you're excluding from whatever we're excluding, whether it's taxes or something else. All right, now this I don't see, but what I do know There's a lot of you guys, when I try to have you, or when I ask you to explain to me the exclusion ratio on the variable annuity, sometimes I hear crickets. So let's look at the variable annuity and what's happening. So this guy, William here, he bought a variable annuity. Remember, this is an annuity where we have the cash value is variable due to the drivers or the engines of growth, which are going to be the sub accounts. And he's at age 63 for 15 grand. That's what he bought it for. So just keep in mind that as he's recovering this over time, it's going to be excluded from taxation, right? Because this is a non-qualified annuity, meaning we funded this thing presumably after tax. His annuity will be paid immediately in annual variable installments for the rest of his life. That's another thing. Watch out for the amount, when the amount that's being paid out, when it's actually being paid out. Is it an annual basis? Is it a monthly basis, a quarterly basis? Is this guy starting payments in November of 22 or January 1st of the year? And watch out for those little curveballs in there. Now, his life expectancy is 21.6 years. Another way to translate this is this guy is going to recover this 15 grand, this non-taxable portion of each payment, over the next 21 and a half roughly years. Okay, the tax-free amount of each payment until he has recovered the cost of his contract equals how much? Well, here's our investment in the contract. Let's just put that as 15 grand right off to the side. There's his 15,000. We're going to put that in red to symbolize and get you guys used to, if you're not already used to it. When I'm writing in red, typically it's a cash outflow. Now, it could be a cash outflow from his checking or savings account over to his Ameritrade or account, or to whatever annuity it is. It's going from one pot of money to another, but nonetheless, we just want to use red to symbolize that we have some type of cash outflow. So investment in the contract divided by the number of expected payments. So how many expected payments do we have? 21.6. But, again, be careful, because they're telling you this is 21.6 years is the number of years, are the number of years he's going to recoup this 15 grand. But if it was over a monthly basis, we want to pay attention to that figure. Okay, just adjust this accordingly. So now each one of his payments is going to be, if you take 15 grand divided by 21.6, it's going to come out to our 694.44. Okay. Remember, this is a variable annuity. So the payouts that he's getting are going to be dependent on the performance of those underlying sub accounts. So, we have a good movement in the market or whatever. His first payment is equal to $800. All we're simply going to do now, $800 is flowing in. Whoops, there we go. 800 is flowing into his pocket, and we're going to subtract the 694 and some change over here. And what will include that comes out to be $105.50. All right, so that's what's going to be included in his gross income, because once again, he's recouping this 15 grand over a 21.6 year period. Now, where it can get a little bit tricky, let's just go to the next slide. I'm just curious, actually, before we go to the next slide, do any of you, see if you're doing, doesn't really matter on the program you guys did, but you guys probably did insurance after general principles. So, for a lot of you, that was almost a year ago. Some of you more than a year ago, depending on your time. Does anybody remember going over the exclusion ratio, not for a fixed annuity, but for a variable annuity? So I'm just curious. And whatever, you can shout it out, or you can just drop me a message.
I remember covering exclusion ratios, but I just don't remember exactly for what, whether it was variable or fixed.
Okay, you probably did. You definitely did it for the fixed. Thanks, Luis. And then, yeah, Rhonda. Okay, Rhonda doesn't remember either. Okay, so that's what I thought. Oh, Amira, what's my YouTube channel called? It should be under Pro Exam Tutors, or you can just look up my name in there. If you can't find, just go to my website, and I know there's a link to there. We revamped the website, so if you don't find stuff too easily, then I'll talk to my marketing guy, who I mentioned is my cousin. He does a good job. Okay, Sharon, yeah, what's going on?
Hi. So the first payment, the $800, that's a yearly, right?
That's correct. Yeah. So yes, and I'm glad you asked that, because they're telling us where to go. Paid immediately in annual variable installments.
Okay, perfect. And then my second question was
Mhm.
for variable annuity, why is the denominator number of expected payments versus for a fixed is benefit over the life expectancy?
Okay, so both of them, you're going to have as the numerator the expected, excuse me, not the expected, but what the guy actually put into the contract. So
Mm-hmm.
for fixed and variable, numerator is what we have contributed. Okay, for the fixed, and there's a couple comments here, so I'll get to those in a second. For the fixed, we know. Let me just go back up here a second. No, okay, that's right. I made that last the fixed annuity statement up. So I'm just gonna make it up again. I think say, and I'm not gonna change the colors here. So well, maybe I will. I'll make it a little. Let's add some color to this dry topic. Right here's 200,000 the guy put in, and then remember I was saying in the insurance company said we're gonna pay $1,000 a month for the next 20 years. That comes out to $240,000. That's the numerator. Okay, because it's fixed. We know what exactly each one of those payments will be. It's going to be exactly $1,000, and we just want to figure out, um, uh, relatively speaking here, what, or not relative, but we're looking at the exclusion. How much of each one of those $1,000 payments will be excluded from taxes? Here, we don't know what the payments are going to be, because these are variable payments. 1 month we're going to have $800 sent to us, and then when the market does poorly, like it has been last couple months, then we're only going to get $400 that month. Okay, so that's why the denominator has to be the number of payments, the total number of payments, which in this case just happens to be the number of years. Okay, does that make it a little bit less confusing, I guess? I know you guys have a lot to confuse.
Yeah, it does. It does. That's helpful. Thank you.
Okay, perfect. All right.
So, but
Mhm.
I mean, are the payments monthly or annual?
In this one, it's so, I know, Luis, it looks like such a small number. In this one, it is what the question tells us, and it is on an annual basis. Although this looks like,
I mean, it's just $15,000, so
yeah,
yes, that makes sense.
it's just an example. Yeah. So,
Okay.
okay, let me see. Well, that's good. I'm not getting any.
And Sev, I've been doing it the second way that you're doing it, and
Okay.
I found it to be fewer steps and so much easier. And I don't even need a financial calculator. I can just do these in my head. I'll just
Okay.
take the amount, like it's 50,000 and it's 10 years. I can do it quickly in my head, and I know that's the portion that's taxable. Like you said, staying on
Right.
the same side of the question, so
Yeah.
I always calculate, okay, what's going to be my taxable amount, and just make sure I read it carefully and look at, is it annual or monthly? And are
Yeah.
they asking for the part that's taxable or the part that's non-taxable?
Good call. Yeah, Jackie, if you're doing these in your head, well, that's really good. So you got a good chance of passing. So you got the horsepower for sure. But yeah, that's what I was saying. Just warning you guys, stay on one side. You're always going to be calculating what will be excluded, whether it's taxes. And there's another example I'm trying to think of it that might be in retirement or in estate planning. I just can't think of it right now. It's not top of mind, but whatever topic it relates to, we're going to be exclude, or like a tax question, excluding stuff. All right, now check out what happens here. His first payment, I mentioned, is 800. So this, every single payment that this guy gets up to and including 694.44 is a return of his investment in the contract. Where they can twist the knife on you a little bit is right over here. His second year payment is only $600, okay, because he's got a variable annuity. It's going up and down every year or whatever. And now they're paying him $600. So then what happens? He's got a choice. He can get this eligible amount tax-free in the second year. He can get all of this 600, because I mentioned each one of the payments up to and including 694.44 will be returned to him income tax-free. What did he get? He got $600. And so he kind of has built up a little bit of goodwill with the IRS, maybe. Just think of it that way. How many remaining payments does he have? Well, he's now 2 years, into this. He opened this when he was 63. He got that payment. 64, remember, he got 800. Now at 65, he's got $600 coming his way. And so they will give you this. They'll give you the table 5. This is the life expectancy. They'll say, hey, the table, this guy now is going to live for 20 years. What we can do is actually take this $94.44 and divide that by 20, whatever that comes out to. It comes out to $4.72. And we can add this $4.72 to my original basis recovery amount. So that now up to including 699.16 is going to be a return of my basis. Okay, so just watch out for that. Again, in the study group, where I'm going to do questions and topics that either you guys ask me about, or topics and questions that are obscure, or topics and questions that I know have a very high likelihood of being asked in one way or another. Okay, now annual taxable amount in his third year, it's 900. So we had a nice recovery in his annuity, and he's going to subtract about $700. This is all recovery of his basis, and he's good to go to pay income tax on $200. All right, that's our variable annuity. So let me see if we got any questions there. Let's see. GW said, what happens if the payment is less than the exclusion ratio? There you go. GW, that's right there. I think that, yeah, if it's 600 instead of 694. Okay, great. There we go. Sorry, I was a little bit behind on the and checking the messages there. All right, let's do our next topic. Now, if you, in real life and in CFP life, if any of you mention health insurance to me, so what happens is, I don't know if any of you blacked out before, but if you do black out, sometimes it kind of comes from the edges. All right, and then you get like this tunnel vision if you're not completely knocked out, and then then it opens up again. Okay, that's what happens to me with health insurance. If a blackout or a fog comes over, I'm just going to tell you what I think you need to know on a handful of topics for health insurance. I'm sure you're welcome, Carrie. No problem. All right. So health insurance, I already feel the anxiety coming on. So I'm going to try and make this as easy as possible. Anxiety on my end. Okay. Health insurance, I hate it. I mentioned I've taught for many years. I've taught all of the modules, enjoyed all of them, especially insurance. This is the one topic inside of one of the modules that I just don't do well with as far as like interest. I'm like, it's all even in real life, health insurance stuff, I take care of everything else, organize the bills. Health insurance related goes to my wife. You handle this. I can't handle it. Okay. I know others of you probably feel the same way. Anyway, know the ins and outs of your HMOs, PPOs, and point of service plans. That's our baseline. Then you're going to have to know how to apply HMO, PPO, point of service plans. So if we have a question, we have a fictional character that, let's use the young married couple again. Young married couple is starting out, and budget is a concern. They're in their 20s, 30s. Health is perfect. What do we need a PPO for? We'll just go to HMO. Okay, we don't do any skiing or jumping out of airplanes, stuff like that. Just kind of a low-key life, low chance of getting hurt. HMO is what it's going to be. PPO, we're going to have somebody, I don't know, he or she is in the middle 40s, some health issues, nothing of a huge concern, or maybe there's a busted shoulder or knee somewhere, and I want to stay with the same doctor. Then we're going to go with the PPO. And of course, I'm not going to go over everything, obviously, with these different plans. HMO, we're going to have a gatekeeper. PPO, no gatekeeper. Point of service plan, we have a gatekeeper, but we can go outside of the network and we're still covered. Whereas HMO, we got to go through the gatekeeper and we got to stay in network. If we go outside of it, we're not getting covered unless it's an emergency. Okay, application. Know the basics and then know how to apply it. Note that there is a difference between a stop loss and then a maximum out-of-pocket calculation. I don't think we'll have a chance to do a maximum out-of-pocket and stop loss questions today. I will put those videos up on my channel. Again, just give me some time on that. Okay, everything related to HSAs, FSAs, medical savings account, all of those things, especially as it applies to what somebody should put away, what are the different rules. That's going to be probably one of the driest areas of insurance, knowing the difference between those plans. Yeah, so PPO, there is no gatekeeper, Carrie. All right, but with a point of service plan, what you're going to think of a point of service plan is a hybrid between an HMO and a PPO. HMO, gatekeeper, has to stay in the network. If you go outside the network, you're responsible for that entire bill, unless it's an emergency room visit. PPO, no gatekeeper. I can stay in network and I'll have a lower out of pocket. I can go out of network and I'll have a higher out of pocket. Okay. Point of service plan, gatekeeper. If you stay in network, costs will be out of pocket will be lower. If you go outside of the network through the gatekeeper, then you'll still be covered, unlike an HMO. It's just that your expenses will be higher. All right. So spend some time on knowing the differences between those three plans, because you are going to be asked about those. All right. HMOs, before I was married, I was fine with it. Why? Because it was the cheapest thing. Really didn't go to the doctor or whatever. And then it was, after 4 years, and then my wife and actually my wife and mom both got on my case, which is good. To you should just go doctor and check out doctor. Now, played out, my wife wanted to stay with her doctors and going with a PPO. Like, all right, whatever, we're gonna go PPO. Like I said from the outset, I said, you want PPO? That's totally cool with me. I don't care, as long as I don't have to look at any health insurance related stuff, then that's fine, because that's like the fog was coming in. Don't ask Medicare questions. It's like on a financial, as a financial planning client, if they ask me a Medicare question, I don't know, go talk to the Medicare expert. I'll deal with that stuff. No, thanks. Cobra, know your Cobra rules, 18, 29, and 36 months. Let me just see if I can give you a little tip on Cobra stuff if it's 18 months, 29 and 36, and this doesn't exactly work out like this, but let's say if you lose a job, here's losing a job, or get downsized, if you're on your spouse's plan and he or she gets, let go, fired, if it's not for gross misconduct, whatever. Okay, so we can stay on the employer's health insurance. An employer has to offer this if there are 20 or more full-time employees, 40 or more half-time employees, or a combination, right? So if we've got like 15 full-timers and we have 10 part-timers, we have the equivalent of 20 full-time employees. Make sure you're aware of that. So 36 months is the most. So I go to the extremes. Here you have death, and then we have divorce, which, let's say, I would consider it the death of a marriage. A couple other categories here, a couple other categories here. Losing a job is bad, but let's say it doesn't get, just so we can think about it this way, it doesn't get worse than the death of a person or the death of a marriage. It's worse than losing a job. Just think of it that way. And then somewhere in between here, then we have disability. And there's a couple other things in here where the employer by law is required to offer to you to stay on their insurance. They don't have to keep you on there if you don't ask, but if you tell them and you make an affirmative election, we've got to stay. They have to extend that insurance. And you guys probably know it's like, they can charge you 102% of the premium. If the premiums are $1,000 a month, they can start charge you $1,020 to make up for the administrative expense. Okay, so COBRA stuff, make sure there's an election and payment due date. The language changed on it recently. Just generally speaking, we have 60 days, no less than 60 days to make a COBRA election. And once we make that COBRA election, we've got 45 days from that election date to pay the premiums. And of course, we have retroactive premiums from the date that the event, whatever it was, loss of job, death, disability, divorce, whatever it was that caused us to be put in a situation where eventually we won't have health insurance. No, really all things Medicare Part A, B, and D, like how much Medicare, hinting here, but how much Medicare Part A costs, which is nothing. How much Part B costs, loosely speaking. Know about your Medicare Part D, your drug plans, your Medigap policies, and your Advantage plans. These are two different things here. Okay, so you're gonna brush up on Medicare. On Medicaid, especially like the 5-year look back. You guys want to be aware of the 5-year look back. It used to be a 1-year look back, then 2-year, then a 3, then a 4. Now it's a 5-year look back. And how do they clip how much you're going to get from Medicaid? Well, Medicaid doesn't want us giving away assets, right? You give away a bunch of assets to your son or daughter, a little bit of a wink and a nod. I'm giving you the family cabin, give you my gold coin collection, my stock accounts, my dear daughter. These are all going to you, wink and a nod, right? Sure, Dad, no problem. And when Mom and Dad need money, here comes daughter back with the gold coins and the cash and the stock. And, oh, you want to stay at the family cabin? Yeah, sure, no problem. Okay. So we don't want that, because what is Medicaid is there not for people to kind of skirt the system or cheat the system and basically cheat the taxpayers. I actually had somebody that was worth like $3 million after I was doing a long-term care presentation come up, and he's like, yeah, how do I, qualify? I'm like, man, you're worth $3 million. Can you relax? Can you save that money for the people that need it? Okay, that's what it's there for, social safety net. But anyway, how are we going to, like the look back period? Medicaid's going to look back 60 months. And so if they see that, for example, you have given away, say, $120,000 4.5 years ago, they're going to say, all right, that's whatever, that's fine. You want to do that, you qualify for Medicaid, but we see that you give away assets 4.5 years ago, within the last 5 years. And, by the way, the average, how are we going to reduce your payments? The dollar amount of the Medicaid benefit that these people are going to get whether it's paying for hospital or long-term care facility or whatever, or in-home health care, whatever it's being paid for, that won't be reduced, but there's going to be a waiting time, and it's going to be the amount that you've given away in the last 5 years divided by the average cost of long-term care in your area. Okay, we don't have to get that detailed with it. They're just going to give you the numbers, so don't worry about knowing what average long-term care costs. And 120 grand divided by 12,000, the average monthly cost of long-term care in your area is 10 months, is 10. So what they're going to make you do is make you wait 10 months to get out to qualify, or I mean, you qualify for Medicare, but they're going to make you wait 10 months based on this simple little formula before your Medicaid benefits kick in. Okay, so now if you just look at the numbers that I made up here, what's actually happening is that to say, fine, if you're going to do the giving away your assets game, then we don't, with the and if you need long-term care, well, you're going to pay the equivalent of $120,000. You're going to pay the equivalent of what you gave away. So, Medicaid stuff, brush up too on what they pay for, and there's a list there. You're going to occasionally refer or continue to refer to that list. I think they pay for, you guys actually at this point know better than I do. I just can't recall that list, but I think they pay for dialysis. They pay for maybe glasses, and for expectant mothers, ambulance visits, that sort of thing. Okay, but you review that list. Social Security, all things Social Security, you guys want to be aware of, especially who gets survivor benefits, who gets spousal benefits, and who gets, I should say, caretaker benefits. Well, obviously the spouse gets spousal benefits here. And I think what I meant there is who gets the caretaker benefits. So let's look at a real life example, just very briefly. Unfortunately, this guy was a great guy too. My wife's cousin, ironically, had a heart attack. He was a roofer, had a heart attack on the roof of a hospital that he was working on. Okay, so you talk about like instant care. It was right there. I mean, just take him down the ER. It's right there. Unfortunately, so 35 years old, and so who got a benefit? Well, he had been paying into the Social Security system. Make sure that your 40 quarters of coverage, and of course your fully versus currently insured, and the 13 quarters of coverage, all that stuff. Know the difference between those two, have that stuff down cold. And so he was 35, wife was 36. So she was not old enough to get a spousal benefit at that point. But what type of benefit was she actually getting? She was getting a caretaker's benefit. Why? Because at that time, her daughter was 14, son was 10. And now I am going to mix up these numbers. So I'm going to just say, I believe this is what it is. Same thing, as long as I've been teaching insurance, certain numbers, I still have to refer to my notes, and I don't have them with me. Okay, daughter's 14. I believe she was going to get a caretaker benefit until the daughter here turned 16. Don't quote me on that. I think I believe it is 16 though. Pretty sure of that. Son, same thing. She's getting a benefit. The wife is getting a benefit because these guys right here are on their age of 16. The only dependents in that household were the two kids. Now, this could apply to a mom or dad, or just so there's no confusion, like a grandparent, a parent of the deceased, or the survivor, a generation above the survivor. They would also, the kids would be getting a benefit up to either age 18 or 19. Okay, depending on their education, if they're in high school or not. Okay, so like it stops at 18, or it stops at 19 if they're still in high school. Okay, so there are two sets of benefits, but she was not getting a spousal benefit at all. All right, so as anticipated, there's a question probably about Social Security coming in. All right, Rhonda, in your example, was she not eligible for spousal benefit because this deceased spouse didn't have the No, she was not 60 years of age, Rhonda. That's why. Okay, 3 sets of people here. You've got the survivors that we are going to paint the picture. Those are going to be the kids. You've got the wife in this example who is not getting a benefit because she's the survivor. She's getting a benefit because she's taking care of at least one person who is under the age of 16. And there's a different rule there too. If we're taking care of somebody who is a dependent, we're providing more than 50% of their not living expenses, but let's just say that we're providing for them a majority of their expenses. Okay. And then when she hits 60, she could start pulling a Social Security benefit based on her husband's, his AIM, his primary insurance amount, which is generated from the AIM, the average index monthly earnings. While I cross into that realm, no, your primary insurance amount and how that's tabulated, that I mentioned is based off the average index monthly earnings. And you want to look for, pull this up at some point, but you're going to want to look for your, I just forget, their your maximum benefit, family maximum benefit, family max benefit. Okay, because if we've got like a surviving spouse and 10 kids, are they going to be getting like $20,000 a month? No, there is a maximum benefit, which is based on the average index monthly earnings, which then leads us to the primary insurance amount. By the way, I understand that, I'm just trying to remember. Yeah, there's a calculation on how to get the AIM. Don't spend like days on it. Just be aware of it. Also, Social Security taxation. I don't believe that I have to double check my notes, but I don't believe that you actually have to do a very complex tax question, right? Like, up to 50% is going to be taxed. The benefits up to 85% will be taxed. And with single or married, what those ranges are. Just be aware that there's taxation there. Know how to calculate or know what happens when you start taking benefits before the full retirement age and what happens when you take it before. There is a shortcut. Let's see if I can recall this briefly, but let me see. If she remarries, then she gets no spousal benefit at age 60. So we do have the choice there, Carolyn. All right. So and we have to pay attention to how long she was married. So it's got to be at least a year for marriage. And we get a divorced spousal benefit. Double check this figure, but at least 10 years of marriage for the divorced spouse. And there's some weird interesting actually rules in there that I would actually spend extra time knowing when a deceased spouse can take the benefits. Are we going to take her benefits on her own work record, or is she going to take the benefits based off of the deceased husband's work record? What's going to pay off? Those things, because let me suggest you do this as you're studying for your Social Security stuff. Again, you're not going to pour a whole lot of time into this, but it might be worth going through a half hour or an hour as you're trying to digest and remember at the same time the Social Security stuff. Mary Beth Franklin, I think from Investment News. You guys have probably seen her. She does a lot of great articles on Social Security, claiming strategies and stuff like that. I mean, now that maybe you hold off till after the exam, but I'm saying study it and maybe put a little time into that, because they will ask you about the different types of people, when they can take and all that stuff. There There's a little shortcut too. You want to know as far as like when we're going to be taking, if I take benefits early, just this is generally, we're not talking about a deceased spouse or anything. And I can't remember the formula, but I know that there's a little shortcut. Like if you do take the benefits early within the first 3 years, you can go 5 years early. But if your full retirement age is 67, but if you go like the full 36 months, 3 years early, you take 36 and divide it by 180. So if you just do that, you come up with 20%. That will be the haircut that you get on your benefit. Now we can't use that if we take benefits earlier than or greater than 36 months. If it's like 42 months, we've got to use that 5/12 or whatever it comes out to be, 5/12 times 12 or something, some goofy formula that you have to be aware of and that you're going to forget as soon as you walk out the door. So look at reduction of benefits, be aware of, Sharon. Yeah, what's up, Sharon?
Would they ask us to calculate what is like the reduction amount or the monthly amount that?
Yeah,
Okay.
totally. They could. Hopefully they don't, but they definitely could.
Okay.
So
Thank
that's why you want to do that little shortcut. Just mess around with it. If you go 12 months early, 12 divided by 180, it's a 6.67 reduction. Okay, and then you can see 1 out of 180 is, whatever that it 1 out of, it's 0.5% basically. Yeah, so you can use that, but that little shortcut of dividing the number of months that you're going early divided by 180 only works in those first 3 years. Yeah, okay, so we've got Social Security. Really, Social Security is there's a lot of rules with it. If for motivational purposes, your own little motivation, if it is boring, because it is, just, and I mean, I think it's kind of interesting, but just think that, look, if you can answer Social Security questions for your clients, it's actually good. That's actually a really good thing. Okay. Yeah. Okay. Alicia, thank you. Reduced benefit calculations. That's just 5/9%. Right. So if you take 5 divided by 9, you get that 0.55. A percent for each month before full retirement age up to 36 months. And 5/12% for each additional month for the next. Yeah. So, and I don't know what the shortcut is. There's got to be for those months that equate to years, taking it early years 4 and 5. Okay, because if we did like 5 divided by 9 times 12, I get a 6.667% reduction in my benefit, permanent reduction. What if I took 12 divided by 180? And lo and behold, I get a 6.67% reduction. All right. Now they're giving you the percentage, like Alicia, thank you for that. They're giving you, if you do 5 divided by 9 times 12, it comes out to 6.667. They're giving you the whole percentage amount. My way, if we go, 12 months early, it's 12 divided by 180. It comes out to 0.0667. So just make sure that you know how to interpret your calculation. Okay, let's cover. Let me just briefly talk about modified endowment contracts. There's not much to them. There really is not. It's, in real life too, if the policy, and there's nothing wrong with selling a policy that's been, tagged as a MEC to a client. I mean, I do that on occasion, when it's appropriate. But we're failing the 7-pay test. Really, all that's happening is that if we take a loan before it, if this policy is a MEC, if we take a loan, we could have, we're going to have a taxable consequence there. If we take a distribution from that policy, usually it's income tax free. Well, it's not if it's a MEC. The death, and this is a point of confusion, the death benefit is still an income tax is still income tax free. And so when I, so not much to max. Just try not to let it confuse you too much, really. So we just have to be aware. You have to build your foundation, the knowledge foundation, and then we have to apply it to a situation. So they're going to give you, somebody who's 58 and he wants to take a trip to Hawaii, and he thinks that taking a loan from his life insurance policy is a good thing to do because he's heard that there's no tax as well. If it's categorized as a MEC, well, he's going to have a little bit of surprise there, and he's going to have a 10% early withdrawal penalty. Okay, so we got to be careful, mindful of those things. Let me show you something. This is exactly what they tell you. This is exactly language from policy. You guys should see this. It says important note. As defined by the Internal Revenue Code, the 7-pay premium has exceeded. It's like, where have we seen that before? We've seen that in our books. Paying a premium in excess of this 7-pay premium in any 1 year of the first 7 years of your contract, or if there's been a material change to that contract, will on an accumulated basis, right? So it's like $1,000 a year is the premium the first 7 years, and I pay it's a universal policy so the first year I pay 1,000, next year I pay 900, next year I pay 1,100. I'm still at targeting $1,000 a year. I'm on pace to be paying 1,000 a year. But then the following year I want to pay more. I put in a $1,200. Now we've kind of flipped that trigger. So it'll result in your policy being classified as a modified endowment contract, which again is not the end of the world. In fact, it may be an appropriate thing. Like if your client wants to make more than 0% sitting in a checking account, and they're sitting on $100,000 to $500,000 in cash, and put them into a life insurance policy, they might be, after expenses, being able to earn 2, 3, 4% earnings. Okay, like I said, I do that on occasion for clients. Life insurance policy is a MEC, a withdrawal or a policy loan may be taxed upon receipt, and we could have a 10% 10% penalty on the distribution as well. Okay, so real life. That's exactly what the language is on that. I can't remember this is North American. Yeah, I can't remember, but anyway, so that's the deal there.